Hey everyone, welcome back to Corporate Decoder, the place where we unwrap the hidden secrets of corporate filings. Today, we're diving into a report that is about to spill the beans on a company that has just hit the public markets. And let's just say their initial steps are quite a spectacle. Get ready. Because we're talking about Vinehill Capital Investment Corp, the Cree's latest Form 8K filing, which essentially tells us about a company's major events. We'll be breaking down their big splash into the stock market, from the IPO details to the agreements they've inked. Before we jump into the nitty gritty, if you love getting these kinds of insights without all the jargon, then smash that subscribe button. Also, we have a thriving community on Discord where we discuss these filings further. You can find the link in the description below. This filing is essentially a report card on significant events for a company. Vinehill Capital Investment Corp, the SU, or VHCC2 as we'll refer to them, has just gone public. Their report details the very beginning of their life as a publicly traded company starting around December of 2025. The key date here is the 17th of December 2025, marking the day their initial public offering, or IPO, was declared effective. This means they were officially allowed to sell their stock to the public. They then followed up with another filing to add more shares, which also became effective right away. So who are these guys? VHCC2 is based in the Cayman Islands and they've got their listing on the Nasdaq Stock Market LLC. Their ticker symbols are VHCPU for units, VHCP for Class A ordinary shares, and VHCPW for their warrants. It is pretty common for companies going public to structure their offerings like this, with units that are a bundle of shares and warrants. Here is a breakdown of what they're trading. They've got units which are made up of one Class A ordinary share and 1/3 of a redeemable warrant. Then there are the Class A ordinary shares themselves and the redeemable warrants, each allowing the holder to buy a Class A share at $11.5. It is common for companies to offer these units, then separate them into individual components on the stock exchange. This section talks about the big deals they've made. The IPO itself involved selling 23 million units at $10 each, raking in a massive $230 million before fees. First up is the underwriting agreement. This is the contract with the investment banks, like Stifel Nicolaus, who help them sell the shares. It lays out all the rules, promises, and responsibilities between the company and the underwriters. It's standard stuff for any IPO. Then we have the private placement warrants purchase agreement. This is where the company sponsor Vinehill Capital sponsor Accession LLC bought 5.5 million warrants for $1 each. These are basically the same as the public warrants, but with some restrictions like not being able to sell them immediately. This is a common way for sponsors to invest in the company. The warrant agreement is with Continental Stock Transfer and Trust Company, acting as the agent for all the warrants. This document details all the nitty-gritty about how these warrants work, like when they expire, how they can be exercised, and any special conditions. This is a really important one for any company going public through this type of structure. An investment management trust agreement. It explains how the money raised from the IPO and the private placement warrants will be held in a trust account. This money is typically used for a specific purpose, usually to find and complete a business acquisition. The agreement outlines how the trustee, again Continental Stock Transfer, will manage these funds and when they can be released. The registration rights agreement gives certain investors, like the sponsor, the right to have their shares registered for public sale. It's about making sure they can eventually sell their holdings if they want to. This letter agreement is pretty crucial. It outlines promises made by the sponsor and company insiders. They agree to vote for the company's initial business combination, which is a big deal. It also covers what happens if they don't find a business to combine with within a certain time frame, usually around 2 years. In that case, they'll wind down the company and return the money to shareholders. The Administrative Services Agreement means Vinehill Capital Partners will provide office space and other support services for $15,000 a month. This arrangement lasts until they either complete their business combination or liquidate. Lastly, there are indemnity agreements. These are standard contracts that protect the company's officers and directors from certain liabilities they might face while doing their jobs. This section talks about stock sales that don't go through the usual public market registration process. Right after the IPO, the company sold those 5.5 million private placement warrants to the sponsor for $1 each, bringing in another $5.5 million. These warrants have some restrictions to prevent immediate selling, and they come with registration rights, so the sponsor can eventually sell the shares they get from exercising these warrants. This part is about changes in the company's leadership. On the 17th of December 2025, several new directors were appointed to the board. John C. Adams, Harvey Marshall Sonnenschein, Jumping Wang, and Daniel Zlotnitsky joined the board, and some of them also took on roles in important committees like the Audit, Compensation, and Nominating and Corporate Governance Committees. It's noteworthy that John C. Adams is chairing all three of these key committees. This indicates a strong leadership role for him in guiding the company, especially during its early stages. As we mentioned before, new indemnity agreements were also put in place for these directors and officers. This simply states that the company's governing documents, their amended and restated memorandum and articles of association, became effective on the 17th of December 2025. This is the legal framework for how the company operates. Here we get into some other important details. The $230 million raised from the IPO and the private placement warrants minus some fees is being held in that trust account we talked about. This money won't be touched until the company completes its initial business combination, or if shareholders vote to change how the company handles redemptions, or if the company can't find a business to combine with within 24 months. They also issued press releases regarding the IPO pricing and the closing of the IPO on the 17th of December and the 19th of December 2025. Respectively, these announcements are standard practice to inform the public about these major milestones. This is the list of all the documents that are attached to this report as exhibits. It includes all the agreements we just discussed, like the underwriting agreement, warrant agreements, and trust agreements. These are basically the full legal documents that back up everything mentioned in the report. Here is the underwriting agreement, the foundational document for their IPO, and the warrant agreement detailing how the warrants work. This is critical. Again, the investment management trust account agreement outlining how the IPO proceeds are held. And finally, the form of indemnity agreement for officers and directors. The report is signed off by Nicholas Petruska, the Chief Executive Officer. This signifies that the company is officially attesting to the accuracy of the information provided in this filing. Now, looking at this report as a whole, VHCC2 is essentially a shell company that has just completed its IPO and secured a significant amount of capital. Their entire strategy is now focused on finding a viable business to acquire within the next 24 months. The success of this company hinges entirely on the management team's ability to identify a good target, negotiate a favorable deal, and then successfully integrate that business. The risks are quite apparent. If they fail to find a suitable acquisition, the company will be liquidated and the capital will be returned to investors. This structure is often called a SPAC, or Special Purpose Acquisition Company. The sponsor's incentives, their $1 per warrant price, is a common mechanism to ensure they are motivated to complete a successful deal. The $11.5 exercise price for the warrants also suggests the target business is expected to be valued significantly higher than the initial IPO price. The good news for investors who participated in the IPO is that the funds are held in trust, providing a layer of protection. The company is essentially playing a high-stakes game of finding the right partner. Their direction is clear: acquisition. The notable opportunity here is the potential for significant upside if they choose the right business. The risks are the execution risk of finding that business and the market conditions at the time of the proposed acquisition. The key takeaway is that VHCC2 is not an operating company yet. It is a vehicle for acquiring one. Investors are essentially betting on the management's ability to execute their acquisition strategy. Alright, that is our breakdown of Vinehill Capital Investment Corp, Thuga's latest filing. What is your take on SPACs and this company's chances? Do you think they'll find a good acquisition target? Drop your thoughts in the comments below. If this deep dive was valuable, hitting that like button really helps us out, and subscribing ensures you won't miss our future analyses. And don't forget to check out the Discord link in the description for more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.